Welcome to another video in our series where we're pulling back the curtain on mortgage secondary and capital markets and sharing insights with sales teams. This time, we're going to be diving into mortgage locks. We mentioned previously that once a lock hits the lender's pipeline, secondary is fully engaged trying to manage interest rate risk and preserve margins. Since this topic is so important to secondary's role and drives many of the questions sales teams have for secondary, we're going to break locks into two separate videos. Many of the lock-related questions loan officers have revolve around lock strategies and practices, as well as constraints they come up against in lock policies. But to really grasp what's driving these, we really need to understand the financial implications of locks, as well as some of the challenges faced when managing interest rate risk and margins. We're going to kick things off by briefly defining locks and other related concepts. Then we'll spend most of the video explaining some of the hedging and modeling considerations around locks, in addition to some other margin and policy-related considerations. While we won't get into specific lock policies here, we will introduce the core concepts that underpin their importance and rationale. In the video that follows, we'll compare externally hedged locks to internally hedged locks, then wrap up with a Q&A of some lock-related questions sourced directly from loan officers. If you're unfamiliar with hedging and its basics, we suggest revisiting our Intro to Hedging video, as this material will be expanding on some of the information covered in that video. So let's get started. A mortgage lock refers to an agreement between a borrower and a lender to secure an interest rate, protecting the borrower from potential increases in prevailing interest rates throughout the origination process. The lock only protects the borrower. There is no benefit to the lender other than protecting the interests of their customer. If interest rates improved after the lock date, the borrower has the right to request a renegotiation of the locked rate, or they can cancel and lock with another lender. If rates worsen, the borrower gets to keep their rate and the lender is exposed to any reductions in the loan's value. When a loan is locked, the price at lock establishes the day one margin the lender is expecting when they close. Since the lender is anticipating this revenue is a major part of the business income, secondary is tasked with retaining as much of this margin as possible so the lender doesn't have to make budget cuts somewhere else or build additional margin into rate sheets to meet their profitability targets. As we mentioned before, margin can easily be reduced throughout the lock process through things like hedge losses and excessive concessions. But margin can rarely increase even in an improving market. And typically, far more margin can be lost during the lock phase than can be made up by sale by secondary finding a better execution. So this is why secondary teams need to be extremely disciplined at managing locks and hedge performance. There are two predominant ways secondary will manage interest rate risk and margins. One is by ensuring the lock pipeline is hedged effectively so the lender doesn't sustain hedge losses. And the other is by trying to limit excessive margin losses. As a reminder, excessive margin loss is considered any margin loss that isn't specifically required to save a deal with a customer. While renegotiations are often required to save a deal, an example of excessive margin loss here would be reducing the rate by a quarter when the customer would have stayed for an eighth. Other examples of excessive margin loss include things like waiving extension fees, misquotes that need to be honored, operational errors, and more. Before we talk about how locks are hedged, we need to cover a few more definitions. Pull-through, as it relates to locks, refers to the percentage of locks that successfully move through the entire loan process and result in a closed loan. A high pull-through rate indicates that a significant portion of locks progress to closing. The primary objective of hedge models is to accurately predict pull-through in different interest rate environments because this has the single biggest impact on hedge effectiveness. Fallout is the inverse of pull-through and refers to the percentage of locks that do not proceed to closing. There's also something called soft fallout. Soft fallout refers to the percentage of loans that would have fallen out had a renegotiation not been offered. Renegotiations directly lower the lender's day one margin, and they also introduce hedging-related risk in a rally that can be very difficult to model. With those definitions behind us, let's dive deeper into hedging locks. In a previous video, we explained that the goal of managing interest rate risk on a locked pipeline is to offset any gains with losses by hedging a financial asset with a related financial instrument. In the case of hedging a mortgage pipeline, the locks are the asset, and TBAs are the most commonly used financial derivative for hedging locks. We also mentioned that the value of locks and TBAs do not have a one-to-one correlation, primarily because of things like changes to fallout, renegotiation, and varying degrees of market sensitivity, along with other contributing factors as well. So you can't successfully hedge a position by simply matching off the volume of pull-through weighted locks with selling a corresponding amount of TBAs. Instead, to accurately hedge a position, sophisticated analytical models are utilized to pull in huge amounts of data to try and determine the pull-through and margin-adjusted value of the locked pipeline and its likely response to different interest rate environments. These model-generated outputs help establish appropriate coverage ratios that guide hedgers when applying TBA coverage in various market conditions. The one major point I want to make is that a model's analytical outputs are highly dependent on the quality and accuracy of the input data it receives. Even if it's a world-class hedge model, in cases where there's a high degree of randomness or variability in the lender's business practices around things like pull-through, renegotiations, and extensions, renegotiations and other margin reductions aren't tracked or adequately accounted for, stale or inaccurate data is fed in from the pipeline, or if insufficient historical data is available, like there was material change in the lender's business practices, the probability of the model failing is significantly increased. While we won't go into detail here, most lock policies are specifically designed to proactively mitigate these potential issues. Remember, if the model isn't accurate, the hedger won't apply the right amount of coverage, leading to the position being unbalanced and the lender potentially sustaining significant margin losses, which will often either directly or indirectly impact the sales teams. All right, back to hedging locks. To protect against interest rate risk, all locks are hedged from the day of the lock until the loan's final disposition, and the lender's hedge position is adjusted daily based on modeling outputs. If the wrong amount of coverage is applied and the market moves unfavorably, the lender will suffer losses. Let's look at an example when too much or too little hedge coverage is applied. When more TBA coverage is applied than is needed to balance the lock pipeline, it leads to an overhedged or short position. Remember, when the market rallies, the short TBA position loses money, so this extra hedge coverage will likely lead to financial loss. Some things that can contribute to an overhedged position include inaccurate modeling inputs and/or outputs, misjudging after-hour lock volume when placing end-of-day trades, and mistimed trades. Of these, sales teams can most directly impact modeling inputs related to pull-through, renegotiations, and stale data, so we're going to focus on these. Let's use a non-mortgage example. Imagine Jack is playing a game where the objective is to balance out a plate of apples. Except, to start the game, the plate of apples is covered by a box, so Jack doesn't know for sure how many apples are on the plate. However, he remembers seeing 6 apples on the table when they were setting up the game earlier. Jack looks at the box, and judging by the size, 6 apples seems probable. So, using the information at hand, Jack puts enough counterweights to balance out 6 apples. Unfortunately for Jack, the scale tips strongly towards the weights, and he loses the round. When the box is removed and they do a grand reveal, there are only 5 apples instead of the 6 he was predicting. Bringing it back to a lock pipeline, if a model takes in information including bad or inaccurate data and it predicts a higher pull-through than actual, the hedger will apply too much coverage, leading to an overhedged position. Pull-through is the single most important input for the hedge model to get right for establishing an appropriate coverage ratio. Having a predictable pull-through is more important to modeling than having a high pull-through, although ideally you'd have both. If a lender's pull-through is too unpredictable in different market cycles, or if there's significantly variability branch to branch or loan officer to loan officer, even if appropriate model adjustments are made, the model may have difficulty producing a reliable, accurate coverage ratio. We'll talk more about things that can contribute to erratic pull-through separately. All right, back to the balance game. Good news for Jack, he's given another try to balance out the plate of apples. This time the apples are right in front of him, so now he knows there are 5 apples. Feeling good about his odds, Jack puts on enough counterweight to balance the 5 apples. But the scale still tips towards the weight. When they spin the plate around, Jack sees there are giant bites out of 2 of the apples. When it comes to a lock pipeline, a hedge model might nail the prediction of pull-through, but if it doesn't correctly foresee and include adjustments for margin reductions like renegotiations, the estimated value of the lock pipeline will be off and the position will be unbalanced. While accounting for margin reductions typically doesn't impact the coverage ratio as drastically as pull-through, it can still have a material impact on hedge results in rallies, and especially in black swan events. Modeling renegotiations and other margin reductions is very difficult to do accurately, especially if the lender doesn't follow firm guidelines. So lenders will create policies to limit the number of allowable renegotiations and apply other restrictions that introduce parameters that improve predictability and modeling accuracy. This helps mitigate the lender's losses. All right, third time's a charm. This time Jack knows there are 5 apples, 2 of which have bites out of them. Feeling good that he has all the information he needs to nail it this time, Jack puts the weights on, adjusted for the number of apples and accounting best he can for the weight loss from the bites. But somehow it's still tipping toward the weights. This time they let Jack pick up the apples. The game was rigged. One of the apples is actually a red balloon disguised to look like an apple. Jack loses the game and all his money. Back to the lock pipeline. Like the weightless balloon, if there are deadlocks in the pipeline that never get canceled, but their volume is still being hedged, it will lead to an overhedged and unbalanced position. If the market rallies, the lender could sustain significant financial losses. This is why it's extremely important for pipelines to be managed closely and locks to be canceled promptly if the deal has fallen through. Extending deadlocks can introduce a significant amount of hedge risk, which is why allowing auto extensions can be extremely risky to lenders if not managed appropriately. While there are a lot of other contributing factors related to modeling that could lead to an overhedged position, pull-through, renegotiations, and pipeline management are the three that are impacted directly by loan officers' business practices, and the three that lock policies and/or customized modeling adjustments try to address. However, I really want to highlight that while modeling adjustments can be made to try to accommodate some behaviors, every time you make a modeling adjustment, you can potentially introduce new risks. So adjusting business practices and lock policies is always the safer and more appropriate way to address hedge ineffectiveness. Two other major factors contributing to overhedged positions that have little to do with sales teams include if the hedger misjudges after-hours coverage or if they mistime their trades and the market moves significantly. While timing issues and misjudged trades can lead to some hedge losses, usually these losses are negligible compared to hedge losses related to inaccurate model outputs and coverage ratios. So that's our overview of an overhedge position. When too little TBA coverage is applied than is needed to balance the lock pipeline, it leads to an underhedged or long position. As a consequence, the pipeline becomes vulnerable to losses when there's a sell-off and interest rates rise. Things that can contribute to an underhedged position include modeling outputs like inaccurately low pull-through predictions, timing issues like the trader not getting new locks covered before the market sells off, and misjudging after-hour lock volume when placing end-of-day trades. I want to touch on this a little bit more because this forms the basis for policies around after-hours and overnight locks. Hedge positions can only be traded during bond market hours, but most lock desk hours extend beyond the bond market. This means at the end of trading day, hedgers will adjust their coverage based on the day's lock and sale activity so far, plus anything they anticipate could come in after hours. Usually, this is based on backtesting. If a lender typically gets about $5 million in after-hours locks every day in a particular market environment, the hedger will anticipate that and apply coverage for those expected locks when they're adjusting for coverage before the market closes. Well, let's say the lender allows locks 24/7 and some of their high-producing loan officers float a large amount of their pipelines. We'll say 20 million in floating locks for the organization. If something happened in the overseas market that triggered all the LOs to lock their floating pipeline overnight, the lender may take 20 million of overnight locks instead of the 5 million the hedger was expecting. This would leave their positions 15 million long. If the market immediately sells off at bond market opening, before the hedger can apply coverage in the morning, the lender could sustain sizable losses. So there are a lot of things that can contribute to a hedge position being out of balance at any given time, some of which are related to the sophistication and accuracy of the hedge model and analytics, some are related to the hedger's trade decisions, but many are related to the lender's business practices and how well secondary and sales work together to mitigate interest rate risk. But just how significant is an improperly hedged position? Let's consider a scenario in which a pipeline valued at 400 million was overhedged by just 5% during a market rally with a 1-point price improvement. In this situation, the consequence would be largely avoidable loss of $200,000 for that single market event. For reference, a 1-point rally can happen several times a year to several times a month during really volatile times. You might be wondering, if the market turns around, wouldn't there be a chance to recoup the losses? There's a common misconception that if the market moves up and down and the hedge position maintains its imbalance, whatever money is lost in one market direction is gain in the other, so it should come out in the wash. While in certain cases, gains and losses can balance out in a market reversal, the underlying dynamics result in a much greater margin compression during a rally compared to the potential upside during a market sell-off. This imbalance creates an asymmetrical curve, causing the costs incurred during a rally to typically outweigh those in a market sell-off. Furthermore, factors like spec pay-ups tend to diminish rapidly in sell-offs, where they generally have a slower impact on the improving price during a rally. Lastly, market sell-offs tend to occur quickly, while rallies tend to be more gradual. Therefore, gains and losses associated with maintaining an imbalanced position during rallies and sell-offs will typically not come out in the wash. All right, we've established that locks are exposed to interest rate risk and that all locks need to be hedged effectively against this risk to protect the company from losing money that could be put to much better use boosting the company and sales teams instead of being lost into the ethers of the secondary market. Another important consideration is that every time coverage is applied or removed, there's an associated cost for that transaction. Anticipated hedge costs are usually built into the rate sheet pricing, but if hedge costs exceed what are expected, it can be a form of margin loss on locks. While hedge transaction fees are an anticipated and unavoidable aspect of pipeline hedging, There's a potential for excessive margin loss if trades persist on dead locks that haven't been canceled. Likewise, locks that are extended beyond the initial lock period will continue to accrue hedge costs. If extension fees are waived on those locks, or if they ultimately fail to close, that can be a form of excessive margin reduction as well. So secondary will be trying to maintain vigilant oversight of the locked pipeline to ensure dead deals are getting canceled, and they may maintain a fairly strict policy against waiving extension fees. Before transitioning to our next video, there's one more important point to address as it relates to locks. The duration of a lock period directly correlates with the level of exposure to interest rate risk. For instance, during a 15-day lock period, interest rates are unlikely to undergo significant shifts unless a major market event occurs. However, in the case of a 90-day lock period, the probability of a substantial market fluctuations from the lock date is significantly higher. Anyone who's looked at a rate sheet will be familiar with the shorter lock periods having more favorable pricing. Keep in mind, lock pricing are derived from TBA prices, which mirror investor demand. The farther out the trade settlement date, the more cautious investors are about the security, leading to lower bids. For instance, bids for a Uni 4.5 with a June settlement might be at 101.23, while the same security for a July settlement could see bids at 101.13. This will be reflected in the rate sheet pricing. This pricing deterioration as the settlement period extends is referred to as the drops in securities. Understanding drops in securities is important for understanding certain lock extension policies. When a loan is locked, hedge models create specific forecasts concerning fallout and projected future trade prices based on lock characteristics and the lock time frame. As the extension duration lengthens, the lock becomes more exposed to market movement and has a heightened risk of falling out. This explains why most extension policies curtail the number and/or the duration of permissible extensions, and extensions are often accompanied by a fee to account for the escalated risk. We'll dive further into this topic in an upcoming video dedicated to lock extensions. Alright, now that we have some solid footing, we're ready for the next lock video where we're going to be talking about externally versus internally hedged locks and answering some loan officer sourced lock questions.